Welcome to our audience. It is a pleasure to have you all here. Thank you so much for tuning in today. My name is Lily Taft. I am a member of the CFA Society San Francisco, as well as a part of our Young Leaders Council. It was really fun to put today's webinar together. We're going to be talking about our 2024 macroeconomic outlook with two very distinguished speakers, James Demmert and Jim Olseth, both Chief Investment Officers at their respective firms. I'll let the two of them introduce themselves in just a moment. But before we get started, there's a couple of items to note. You will be muted for the entire event, but we encourage everyone to type questions as they pop up into the Q&A box. And we'll be sure to monitor those questions closely. We'll try to answer as many questions as we possibly can, but this event will be recorded, so you can feel free to share the replay later on. Without further ado, Sophia, our moderator today, would you like to introduce yourself and our speakers?
Yes, happy to do that. Hi, everyone. Thank you so much for joining and welcome to the CFA Society San Francisco 2024 Global Macroeconomic Outlook. I'm Sophia Dodd, an investor at Touchdown Ventures, and I have the pleasure of moderating today's panel. So as Lily mentioned, I just want to underscore, please submit your questions to the chat, and we're going to endeavor to answer as many of those as possible. So with that, I have the pleasure of introducing our esteemed panelists. Today, I'm joined by James Demmert, founder and chief investment officer at Main Street Research. James is an accomplished investor with over 35 years of experience, and he's an award-winning finance and investment author, and he's just released his newest book, Wall Street Lessons. I'm also joined by Jim Olseth, chief investment officer at Fire Capital Management. Jim is an accomplished investor, spending nearly 20 years in the ultra-high net worth family office space. So we're thrilled to have you both. Welcome, and let's dive in. So, the past year was volatile. It was a year that was filled with ups and downs, which ultimately invited quite a bit of uncertainty. So, Jim, perhaps we can start with you. I'd love to hear your recap of 2023 to really set the stage for the primary factors that are shaping your outlook for 2024. And in particular, it would be great to layer in how any recent events have influenced your perspective.
Sure, thanks for that. And I'll try to be brief to give James an opportunity to opine on much the same. But I think what's on everyone's mind, in 2023, we saw a notable drop in inflation as the lagged and variable effects of tighter monetary policy had the intended outcome to reduce inflation. And despite elevated interest rates, consumers and frankly the government alike continue to power the economy along and contributed to wage growth, low unemployment, and frankly fiscal deficits at this point. So in addition, some positive things that we observed that we find attractive and really present an opportunity for the future as we head into this year and beyond is the advancements in artificial intelligence. So while still in their infancy, likely contributed positively to productivity growth that had been waning previously, and helped battle the headwinds by lower than expected participation rate in the employment labor force. Yet, as we look into 2024, beyond that, there are still plenty of cracks remaining in our outlook. The cumulative hangover of prolonged inflation, much higher than Fed target rates, still remains. And that's led to a reduction in excess savings and disposable income. And we expect that that's likely to contribute to stagnant and declining revenue growth, as well as ultimately earnings. We'll be paying close attention to that in the next few weeks as earnings start to roll out. And beyond that, despite the fact that we haven't received a recession to this point, it's still quite possible given where LEIs tend to tell us where we're headed. And geopolitical tensions are at near tipping points, frankly. On top of that, much of the global economy, starting with Taiwan in a few days, is entering an election cycle. So there's lots of uncertainty as we come into this year. Some things good, some things bad from last year, and it's sure to lead us to an eventful year ahead.
Great. Thanks, Jim. James, it'd be great to get your take as well.
Yeah, thanks, Sophia. And I have to agree with almost everything that Jim said. And the question now is really, to what degree all this stuff has to do with the direction of equity prices. I look back on 23, I look at basically what was a bear market, a continuation of a bear market. I mean, if you take the Mag 7 out of the S&P 500, most stocks were flat, down, or maybe up a little bit. And prior to that, we had a 30 to 40% decline, depending on which index you look at in 2022. So I kind of feel like 23 was really the end phase of the bear market. And in our view, inflation's decelerating. All of the components. I know that today's number was a bit of a surprise, but I think that's just going to be bumps along the way. But our thought has been since really late summer, the Fed is done, stocks will run, because that was the biggest impediment to equity prices. So in our view, you've got a really good setup for macro, in the sense that central banks are finished. Inflation pretty much is gone. And I think what's really important for all of us that are in the business is to recognize, where valuations are. I mean, I know that everybody worries that the Magnificent Seven are trading at high multiples, but if you look at the growth rates, which everybody on the call does, I mean, even in NVIDIA, it's growing at 40% a year. It can trade at 30 times earnings. And the rest of the market's at 15, which is historically cheap, and the financials are at 10. I mean, these are really bargain prices in a macro environment that we think is a really good setup and what we call the beginning of a new bull market and a beginning of a new business cycle, which is a whole new thing. We think it's the beginning of a business cycle. A lot of people say this is late stage. We are on the opposite end of that. And that's why I hope that our comments today, Jim's and mine, can help everybody watching this. And, if you have questions regarding our view or how we're implementing it into portfolios, that's what we're here for. So I look forward to some Q&A as we go forward. So we think there's some really appealing sectors in equities. Totally with Jim, AI is going to be an amazing tailwind. If anybody went to the healthcare conference in San Francisco yesterday, it was literally, a plethora of AI comments from healthcare companies. That's just the beginning, the really early stage of this transformational technological move. And I think it's going to make the economy super, super productive, which we really haven't seen since the 90s.
Yeah, that's great. Thanks, James. Perhaps we can start there within that frame. As we look to 2024, which sectors and asset classes do you see as particularly promising for investment this year, and why?
Jim, do you want to start with that, or
I'm happy to, but you can go ahead if you like.
Go ahead.
Right. So we remain at this point much on the backdrop of what James contributed, where valuations are and where the prospects of, in particular, the U.S. economy is at. Overweight U.S. equities relative to international counterparts, with a slight bend and favor within that to smaller capitalization, given even a greater discount gap there. However, we believe that on the international front, given the cheapness relative to U.S. and the fact that they're further along in the cycle, in our opinion, that they may already be in a recession at this point, and maybe this where James and I might differ exactly where we're at in the U.S. cycle, but they may be ahead of us in terms of coming out on the other side. So there's an opportunity there that we'll be watching closely as the year progresses. However, we would tend to defer to a U.S. bias in nearly all instances, and certainly think that the prospects for growth, AI aside, are stronger in the U.S. as a relatively stronger economy going forward in so many different sectors, and frankly the sectors that we prefer that are more growth oriented, all else equal. Beyond that, we have a bit of a cautious approach. We still while we also agree with James that the Fed and other central banks are likely done, the idea that a pivot is immediately imminent is not necessarily our base case, and frankly, part of that contributes to our preference for On the fixed income side, lower duration at this point. The idea that we couldn't, see that the volatile nature that James alluded to in terms of inflation or even potentially policy rates along the curve. We've seen kind of what's happened already this year a little bit. Volatility, frankly. So we'd rather not take the duration risk at this point. And we have a bit of an overweight to cash that we've taken down a bit as the year went along last year. But the fact that we can get 5% in cash-like securities is frankly a relatively attractive trade given where yields are from equities to high quality fixed income to REITs, frankly, right? So we think that that's a relatively risk-adjusted positive trade for us. Beyond that, we are continuing to add to private alternatives to make up the balance of our portfolio. We're seeing quite a bit of dislocation there and some attractive opportunities that we're trying to take advantage of.
Great. And James, it'd be great to get your take as well.
Yeah, so this is really a question, and Jim, I like your comments, and it's great that we're on this together because we have sort of a different view, and I think that's always great to make this more interesting for those watching. 2024, as we sort of go forward here, I think that investors, I mean, when we think about sectors, asset classes, and such, what do you want to think? What you don't want to think too much about is the election. I mean, elections are literally they're non-event for equity markets historically. They are an event, perhaps, that is sector sensitive. So I think you want to be careful there, and we'll talk about healthcare as maybe a potential target, and you want to kind of watch that. I think that people are a little bit over their skis, and the Fed's going to cut 6 times this year. As Jim alluded, the government, kept this economy more resilient than we thought by spending money like crazy. So you have a very resilient economy. And I think the Fed cuts, but they tweak it. Maybe it's once or twice. They're not going to, unless you really have a downside in the economy, which we do not predict. I think they're going to tweak rates a little bit here and there and not really be aggressive. And I don't think the equity market needs it. You got low valuations, as we mentioned. I think we're going to have very, very strong corporate profit growth over the next few years. A lot of that's going to come from the productivity of the AI and also recalibration. I mean, think about it. Most companies have gone through like a meta experience, slashing expenses in the last year. So you have very strong balance sheets and low expenses. So we got high margins, and all you need is a kick. And I think that kick is coming this year and next and the following. And for those that are worried about the fiscal deficit, remember in the 90s when we had huge productivity growth in the economy, we pretty much solved a lot of our fiscal problems by corporate profit taxes going up like crazy and filling that hole. And I think, as much as we can all worry about fiscal deficit, that might take care of itself if we do get this, what I call the AI bull market and business cycle that we see. So here we want to be like, and again, I'm not a perma bull. As many people know, we were bearish through all the bear market, a little too late, actually. It's not a perfect business, as you know. But we are fully invested. We have been since, I think at the October low, I think Lily, we kind of went in all in to get more back in. And so we're fully invested in equities for every client's investment policy. We are focused on overweighting technology, since again, we do think the AI transformational valuation thing is there. And then when we go out, we're just about every other sector in the market. And that would not include utilities. And we have not yet gone to REITs, but everywhere else we're full in, full up, because we think AI is going to touch industrials, healthcare, and so on. We're a global manager. So if you have Q&A, we're buying individual securities and we're global. So we own ASML over there in the Netherlands. We have positions in the Japanese market. Thank God, because the market there is doing really well. So we're a global manager, and we think investors should be diversified across the globe, look at corporate balance sheets, own strong quality companies in sectors that are going to have this big earnings push that we think is going to have those AI tailwinds.
Great. Yeah, and James, you mentioned not to, over-index on the election uncertainty, excuse me. So I'm kind of curious to understand from your perspective, which risks facing the global economy in 2024 do you feel will have the biggest ramifications on markets?
Yeah, I think, to be honest with you, the list of risks in our view is getting smaller and smaller. It's not valuation, it's not the Fed,
Hmm.
it's not economic disequilibrium with where stock prices are. Those are the things we usually worry about the most. So I think we're looking at kind of black swan stuff. I mean, I think Jim brought up a good point. You got the election in Taiwan, and what's going to happen geopolitically there. I think that could be a concern. The economy is growing. There is a risk that it's growing too fast, and there's no rate cuts. I mean, I think that's a bigger risk than the opposite. So we want to kind of be careful about that. But yeah, I think that the reason we're so bullish is that we can't find any really solid negative information. That could be my own undoing. I can't find a reason to be bearish, but it's hard to see.
I get
Got it.
maybe I'll contribute to try to find some. I agree with everything that James has said there. Maybe I'll just latch on to some of those latter comments. I guess are maybe of the known risk because some of the externalities are harder, more tail risk, harder to identify. But risk in our view is to James' point that we don't receive any of the pivot, any of the cuts, and that's because the economy is still running well above trend and a bit too hot. And the Fed has to kind of even potentially capitulate from here, given that so much rate cuts are kind of priced into this point. And really, that's on the back of inflation is much more sticky and more volatile than we were kind of expecting. Our base case is that it will continue to decline. But given where we're at with deficits and the amount of spending that's happening into an election year where you would expect, and certainly history would tell us that people are trying to get elected. They're going to do everything they can to keep us from going into a recession. So while the economy might be resilient on its own, certainly the government is playing a role there. And so if they were to escalate, and actually there's some talk right now of potential tax cuts and other incentives coming down the pike. If those things were to materialize and they were to put the pedal down on inflation a bit more, and I'm not necessarily trying to be hyperbolic that we're going to return to the previous highs or anything like that, but if it sticks around even longer than we've expected at this point and reverts a bit, that certainly puts, in our opinion, a risk to the economy just in terms of, again, what everything's baked in and where the economy is likely to head on a sustainable level from here. And certainly part of that, the key component as to keeping inflation under control on its own from this point, nearly regardless of what the government does, is that productivity growth that James mentioned. That is so key. What we have seen, however, in evaluation of the previous recessions that either ended in a hard landing or soft landing, et cetera, one of the main contributors was where unit labor costs are, which of course adjust for productivity growth. So they're elevated now. They're at levels that were above trend heading pre-pandemic on where they were, even though real wages are barely positive. And so if we don't see that abate, we feel that that's going to continue to put pressure on margins for companies as they try to deal with labor costs. And if that productivity doesn't follow along with it, which it certainly could, that's a risk that inflation sticks around longer, and we kind of get derailed from here.
Got it. Okay, great. So in hearing, I guess, these considerations, I'd love to understand how you both approach active risk management in your portfolio allocations, and then the strategies that you employ to navigate these uncertainties. James, perhaps we can start with you.
Then yeah, sure. I'd love to share. That's kind of our brand is being a risk manager. I think it's the reason we exist is the active risk management. Otherwise, we would just be a passive indexer like the rest of the world. But we all know, right, that markets go through very difficult periods. We call them bear markets. They're usually linked to recessions or some kind of economic disequilibrium. And you know, my first book was really all about cycles, and you know, it's a great charts of the last 100 years of, yeah, you get a bear market about every 7 to 9 years, and they're usually anywhere between 30 to 50% declines. '08 was a good example. I don't know if anybody is old enough on the call to remember that. '01 probably not. And you know, just last year, you know, it was a 30 to 40% decline. I'm sorry, 2022. Depending upon whether you look at the S&P 500 or the NASDAQ, these are big declines. And so our view is you go out there and be bullish. And frankly, I don't know if I'm the $100,000 man. What I mean by that is I think the Dow goes to 100,000 in the next 7 to 8 years. I know that sounds extreme, but it's based on some good logic and history. But along the way, we could have some significant declines. And so, you know, we approach risk management from 3 different prongs. One is, just as a client says the policies should be 70% stock, 30% fixed income, and every client's different. In a tough market, we're flexible with that allocation, and we're willing to bring 70% equities down to 20, which is what we did in the first quarter of 2022, or back in the first quarter of 2008. So that's number one. A lot of firms don't have flexibility with asset allocation. We're very flexible. Secondly, we're very sector oriented because we buy individual stocks. So we always think, you know, as this guy we all know says, there's a bull market everywhere or somewhere, and we're trying to find it. So, you know, in a tough market, we own Procter and Gamble, and, you know, companies that had consistent earnings, and those stocks did well. And we owned a lot of Novo Nordisk, which was a luckier than smart position, makes Ozempic. So the stocks carried us through, but we didn't have a lot of stocks. So sector orientation is a way to manage risk. And then lastly, the thing that doesn't cost anything, but I think people are afraid or don't use them well, we use stop loss orders. So they're not super close, but we're buying individual securities, and we leave a lot of room for these things to move around. They're really there to mitigate catastrophic loss. That's it, not normal volatility. You know, and when I say catastrophic loss, this asset allocation of being flexible, the sectors, you know, managing them to be in where the earnings are okay, and using stop losses. It's really to prevent, you know, those losses. You know, as we all know, if you're down 50%, going up 50 doesn't get you back to even. You got to go up 100%. And so we're trying to make sure clients never have that kind of loss. So in '08, when the market was down 55, we were down, I think, 12. And it was really that flexible asset allocation, sector management, and allowing stop losses to get executed. So that's kind of, you know, the 3 prongs of what we do to manage risk. I'm hoping I don't see any of those occur this year. But who knows?
Super helpful. And Jim, what about you at FIRE?
I would say that it's a similar approach. You know, it's a bit cliche, but diversification really is important, but not necessarily naively, right? We're globally asset allocated, and what we utilize to give us an edge is a rather sophisticated bottoms up, so holdings level based risk engine that helps us identify where our active exposures is from a risk factor perspective relative to our strategic benchmarks and goals. So that really helps us understand, frankly, know what you own, right, at the end of the day. So we know what risks we're taking, we're comfortable with it, and we mitigate those that we don't want to be taking. That helps us really kind of narrow in on you know, what it is that we're trying to achieve and not what we're not. From there, depending on client risk tolerance and situations in the market, we deploy rather vanilla but effective option strategies to dampen volatility. So we watch what the implied volatility is and put them in place when we feel that we're being compensated for that, to help us kind of take some of that equity beta risk off the table. And then from there, and this is more along the lines of again, pursuing that diversified strategy, we take a programmatic approach with our clients to pursue a diversified allocation to their private alternatives portfolio, and really try to do so across, again, the global in nature, but different strategies, certainly different vintage years. The key factors that we think contribute to what their kind of performance is going to be in those alternative areas. And that really does help kind of dampen the volatility in the portfolio as a whole.
Okay, great. Maybe we can pivot. I want to pull back on this thread that we talked about with AI. I think James actually started to bring it up on the fact that you're bullish on it. We have an interesting question from the chat, and so it's directed to James. You mentioned that AI will increase the profitability of a company, but it also might cause massive layoffs on the job market. And if so, that might be bad news for total spending power in general. And so would love to get your take on how to balance the impact of the two.
Yeah, I love that question. I mean, it's it kind of goes back to the fact that we're in a capitalist world, and higher profits doesn't mean better for society or communities. And I think when you have productivity growth, right, you need less people to do twice as much, and so there is that risk. And in our view, again, trying to keep our heart out of the office and focus on increasing wealth, you want to be careful. Certainly want to watch that closely and see if that does come to fruition. But to me, it seems like a pretty straight line. And I think you'd want to be careful with the sectors that can be sensitive to that, which would be the consumer discretionary sector. There could be some trouble there as you have, people not earning as much. They always feel, oh, we can transition people to do something different. We did go through that in the 90s with the internet. It wasn't a successful venture. So I think that's going to come with it. And I think as investors, we want to be real sensitive to that high likelihood. Yeah.
Yeah. And
where's the money spent is, be careful.
Mm-hmm. And which sectors do you think that AI will have the most impact on? You mentioned healthcare, and so are there any others that you're particularly excited about?
Well, the obvious one is other technology companies leveraging it, right? So that's where you get to
Sure.
Microsoft, Google, and that sort of thing. But yeah, when you get outside of tech in general, in telecommunications, you got to first go to healthcare. I mean, and this is a wonderful thing for society. If we can, get 3 times as much work done than we did before to figure out how to beat cancer, I mean, this is going to be fantastic. And you can just imagine, right, how successful that might be. But we can also see it in the industrial sector without question. You can see it in the financial sector. You can see it in the consumer discretionary. I'm sure they're trying to, AI is figuring out where James went in the last year and where his next vacation should be. I mean, and so I think it's going to touch everything. When waste management talks about AI, I'm like, I'm not sure. but just about everything else, I think is going to be touched by it.
Got it. And Jim, any additional thoughts here?
No, I agree.
Sounds good. Great. Yeah. So Jim, maybe to pivot to you, you've built a career stemming from this ultra high net worth family office segment. How do you see the role of family offices evolving in response to this, shifting landscape?
Sure. Our clients are each bespoke, right? And so not one answer fits all. So I think that, the primary role that we play for them in a shifting landscape and, kind of certain aspects, unprecedented times and high degrees of uncertainty, we give them peace of mind, right? And frankly, they know that we're watching things, much of the things we've already discussed here today. And with the uncertainty and dislocations often comes opportunity. And frankly, with the family office clients and institutions that we work with in particular, because they have large pools of capital, they have the opportunity to use liquidity, or said differently, use the liquidity premium, not needing liquidity to their advantage. So I mentioned allocations to private alternatives, et cetera. So that's an area of opportunity that we take advantage of. And of course, our role gets rather complex in looking at their broad tax and estate situations that become rather complicated that we need to consider. So again, like I said, not all things are equal, but really it comes back to serving as that quarterback for them, so that we understand what their risk tolerances and goals are, what the economic and market landscape is, how we're going to attack it as things evolve. And just to use the coin term, pivot whenever necessary, really take advantage of what we're being given.
Yeah, appreciate that sort of bespoke approach. And so, we actually have a follow-up, I think, from the chat regarding private alternatives specifically, as part of your portfolios. Are you looking mostly at private syndicated corporate credit, real estate, or other alternatives? And can you expand on what dislocations you see in the sector?
Sure. Frankly, all of it, because as I alluded to, it's a diversified approach over multiple vintages, right? So we're trying to invest throughout the cycle, but because we're not necessarily seeing a ton of dislocation at this point, but what we have seen in many areas, frankly, is attractiveness in secondaries. So getting back to that liquidity premium again, we're seeing discounts available where we can provide capital to those who need it that we haven't seen in over a decade. So that's an area of opportunity because of not necessarily a bearish perspective, at least in the first half of last year, but we started to dig deeper into less correlated things, right? Which we would do regardless, frankly, if we think that there's something that we could take advantage of. But kind of given the uncertainty that we've been dealing with, things like litigation finance, things related to that are a little bit interesting right now and a bit counter-cyclical. We've talked about kind of some of the cracks. We've seen bankruptcies expand, right? And so we're invested through a litigation strategy that takes advantage of being the debtor in possession, the last in, first out, top of the capital structure, provider of liquidity to Chapter 11 reorganizations, where we have a high amount of collateral behind us, so we can get our money back, and we're achieving high teens returns on what's very low correlated and even a bit counter-cyclical, just in the nature of the opportunity set of bankruptcy becoming more robust. So it's things like that we're trying to take advantage of.
Got it. Okay, super helpful. Thank you. And James, maybe to pivot to authorship. And so want to touch on your books. Your first two books, The Journey to Wealth, and then The Sustainable Endowment, touch on long-term wealth creation. And then your newest book, Wall Street Lessons, takes more of an evolutionary psychology perspective as to how we can take a more disciplined, rational approach to decision-making. And so would love to hear your commentary on how you employ these, sustainable investment principles and how it sort of aligns with your current outlook.
Yeah, thank you for touching on that. And we're all a bunch of investment geeks. Anybody out there, I always say there's a book in all of us. And if you're ever interested in writing a book, contact me. I really mean that. And I'll give you some ideas of how to approach it. It's a wonderful experience. Yeah, my books are really come from our passion of what we do. And each of them has a theme kind of whittled in it, which is this sort of sustainable risk management style that we employ. And the last book has been was a fun one to write, because it's really about how we all are we're our own worst enemy when it comes to investing. The fear and the greed, and we're running away when we should run towards. And it was fun because I really got to dig into, more medical science of like how our brains work, and, why do we feel like we should invest more the more things go up. It's also it was a good way to go back and see some of the big mistakes I've made in my career and examine them. And a lot of times it did come right back to the root of we're humans, and we're just not, the brain's not well geared for this. So, our process, and we always use the word process, is really about tools and methods to take the human brain away, right? And through a bear market, a bull market, whatever it is, have these things in place so that we can get our brain out of the way and have a discipline. And that's where the stop losses come in, right? They're not perfect, but gosh, we got stopped out of PayPal and it went down another 70%. There's some that we got stopped out of and they went right back up. But generally speaking, it does what it's supposed to, which is, hey, Mr. Client, Mrs. Client, you're not going to have catastrophic decline. You might miss some upside, but you're not going to fall catastrophically. That's the kind of client that, that's a good fit for us. The sector management, right, is a very important methodology we've been using for 30 years since I started the firm. And that's a very important element. As last year was a good example, you had most sectors not perform, right? So it was good to be overweight in certain areas. And then lastly, I just think that common sense, even if you're wrong and you miss some upside, reducing the allocation to equities when the economy's here and the stock market's over here, way out of whack and way out of equilibrium, it's okay to reduce exposure a lot to protect the assets. We don't have to be in all the time. So my books really are taking that risk management approach and looking at it lots of different ways. And the most recent way in the recent book is kind of our psychology and why we're our own worst enemy. Hope that's helpful.
Awesome. Yeah, very helpful. Great. So, before we open it up to audience questions, just want to give you both the platform for, any closing remarks regarding areas that we didn't touch on, but perhaps you'd like to discuss. So, Jim, maybe we could start with you.
Well, sure. So maybe it's something that we're watching, and it's probably going to come to a head as we approach the presidential elections later this year. But it's not really a near-term thing. But to borrow the analogy from actually JP Morgan's outlook, it's kind of the boiling the frog type of thing. And I'm referring to that fiscal deficit where projections have us where the number one line item surpassing defense spending and all others is the interest rate expense that we pay on our national debt, right? And so we don't have to do anything at this point to kind of, or if we don't do anything, there's nothing that's going to stop that from happening on the current trajectory. And if James is right, and we really knock it out of the park with productivity growth, and we're just at the beginnings of a stronger bull market, things will all be fine. In the meantime, we've already had a downgrade. We have a pretty dysfunctional Congress, and so entitlement cuts and things are going to be talked about. Again, in the near-come election and beyond, right? This is something that we need to address in one shape or form. We might find a way out of it, but such that we don't, it's going to, again, continue to be something that kind of lurks in the background. And getting back to that boiling the frog analogy, it sneaks up on you and all of a sudden you're cooked and you didn't know it. So just, not to something, again, near term and not to be hyperbolic about that risk, but it is happening. It's not getting a ton of attention. It kind of shows up when we have a government shutdown pending, and then it kind of goes away again, and so on. And yet we think that government spending and where we're at from a fiscal perspective is playing such a role in the economy and where we go from here. And frankly, as far as volatility is concerned this year and beyond, we have a mismatch between where the Fed is at and where fiscal policy is at potentially, right? And so I just kind of want to point that out, that there's something to pay attention to.
Great. And James, anything on your end?
Every year it starts out, I think of Wayne Gretzky, that famous hockey player who said, "Don't look where the puck is, figure out where it's going." And I think this year it's that, most stocks have been on the floor and they're just getting up. And I think there's a lot of opportunity. But how can we ever have this meeting today without me bringing up Bitcoin? You just opened a floodgate, right, for money to come into these Bitcoin or crypto ETFs. And, like I said, with the human brain, even if it doesn't make sense, money's going there. And I think it's going to be a big move this year. And I'm not even sure I understand it, but I just know money flows. And or let's put it this way, it's probably not going to go down a lot anymore because of the support that's going to provide. So, I bring that up and I think of it just I mean, we're all investors. We have a million alternatives out there. And I love our combination here with Jim, because you guys do private equity and alts and all that stuff. We don't do that. So I kind of learned something today. But yeah, just kind of everybody, let's think about where that puck's going.
Great. Awesome. Well, now I'd like to open it up to the audience. And so just want to encourage everybody to please submit your questions. I'll try to get through as many as possible. So first question from the audience. Often in client-facing roles, you have to take a large amount of complex data and then package that information in a way that's succinct and articulate. And so do you happen to have any advice for those, folks in client-facing roles to take these concepts and express them to clients?
I'll comment on that. I think that we're in a business where people speak a different language, and we have to stop doing it. I mean, it's just, I think when we're younger and we know a lot, we want to give people every detail of what PE versus growth means, and that gets lost. Not just, I mean, even people who understand it don't want to hear it. I mean, we need to get things. I think when you're client facing, the biggest thing you have to work on is communication skills and taking very complicated subjects and making them feel simple. That to me is what makes a great client retention person. It makes a great presenter to potential clients, and an easy person to be around, because you just think conceptually, not too much, the trees, not the forest, not the trees. I think that's the thing I see the most, where we all need to be better at it.
Maybe I'll just add, I don't have a kind of a secret, but what I do in preparing for that is I kind of go through the 5 whys exercise to really try to distill things down at the most basic level that I can, because ultimately, if I'm going to take a complex situation and convey it to someone else in more simpler terms, I need to first do it myself. So while I might understand something well, I get caught up like everyone else does and kind of, well, that's just the answer. Have I really spent the time, particularly when I'm preparing to give it to someone who is less familiar with a given subject? I really need to get it down to what's most important and what's most critical, and kind of be able to build the narrative effectively to tell the story to someone so that they understand it. And frankly, as we're coming through any sort of explanation on something, it always helps to be able to say, and this is why. That really has a kind of more of a lasting effect. So I'm not quite sure that helps everybody kind of necessarily prepare to distill things, but that's my approach, and I find it effective.
I'll mention one other thing, Jim. I like what you just said, and I think also, know your audience. I mean, I think it's really important as we're discussing these types of conversations with other humans that we watch their body language. Are they, have we lost them, right? And I think I've seen sometimes people just talk on, and you can tell the listener's kind of gone into a whole nother realm. They're not listening anymore. So it's really important to engage. And one of my colleagues, Lily, she often will stop throughout her conversation and just say, I'm going to take a pause here. Do you have a question? Right? Make it engaging. It's really important when you're client facing.
Great, super helpful. Next up, we have a question regarding Magnificent Seven stock. So it's been decades since we had such industry concentration. Is that a concern? And if it's not a concern, do you see more antitrust cases on the horizon?
I could start that one. There is a lot of market capitalization in those companies, and I think for a good reason. They are transforming, the economy, and the problem we have is like, holy cow, how can 7 companies have such big capitalization and the rest of the market be so small? And you sort of say, well, how is that ever going to get rebalanced? Are these things going to have to fall apart? And so it all gets back to more equilibrium. And our view is no. These stocks have moved, and the capitalizations have grown because they are important and investors recognize it. But how this is going to become less like imbalanced to us is going to be seen this year. You're going to see the rest of the market start to act really, really well as it also gets on the AI wagon and is perceived to be on that wagon. And you're going to see those capitalizations move up. So my view is by the end of this year or next, you're going to have less of a disparity there because the rest of the market's going to finally pick up. And yes, we still have mega cap stocks for sure, but I don't think anything like we've seen, certainly in the last year and a half.
I generally agree. I'm not particularly concerned. It played a very large role, obviously, in last year's returns. But I also agree with what James said earlier. If you look at multiples everywhere else, it presents an opportunity, and there's plenty of things to do. And more on the AI front, it's touching so many areas. I'm not overly concerned. Frankly, I see it as an opportunity. I do, however, think that antitrust is certainly here to stay. I mean, not that it went anywhere, but the idea that we're going to see less going forward and not more is not where my base case is. But we also have seen diffusion so far this year and at the very end of last year, where the Magnificent Seven had less of a role, and now it's maybe the Magnificent 10 at this point. So we're starting to see that already unwind.
Yeah, and Jim, I would say also the two things you're going to hear less about in this year that we heard only about last year was the Magnificent Seven. I think that's going to finally start going away. And I think anything related to the Fed, and that's going to be a relief, right? No more Fed talk.
I hope you're right. I don't know that the Fed's quite done, but I hope you're right.
I hope I am.
So you both touched on AI. We have a question regarding the AI megatrend. So any thoughts on the best way to get exposure to the megatrend? Do you think it's public or private markets? Just your broad thoughts would be helpful.
I'll just throw one out there. I'm in Manhattan right now, but I love San Francisco. And I think one way to play the AI trade is buy a house in San Francisco. I think San Francisco is going to go through a boom. It's going to be amazing as AI money comes in the private and the public markets. So, that's just my tongue-in-cheek way of saying something great about that city. And I think that we don't do private, but there's going to be super opportunities. Jim can probably talk about that. In the public markets, it's really obvious. I mean, you want to stick with the winners. You want to own the companies that are making it work, the NVIDIAs, so on, and the companies that lever it best.
Yeah, I would agree with all of that, and I do think that you can achieve it not necessarily unilaterally. I think the private markets are a particular interesting way to play kind of innovative technologies and ventures and so on. The issue, however, as we quite know, is that valuations are rather stretched in public as well as private, but particularly what we've seen in the private markets. So not to deter anybody from pursuing that approach, but I think that there's opportunities abound, and without throwing out any particular sectors or names, we kind of think about it as a tech stack or even a sandwich where you've got multiple layers. Again, different companies in different industries approaching it different ways, but you've got infrastructure as a base layer. You obviously have a plethora and a need for data to build upon, and then the top layer would be the applications that rely on that data, right? And so there's just so many different ways that AI is touching so many different companies and end users, even B2B and whatnot. That really it's hard almost not to play it. It's cliche, but the idea that we went through kind of an online revolution, and now you think, well, every company is online. Frankly, at this point, even if they have a brick and mortar presence, they're an online presence. AI is a similar way. We're going through that sort of revolution. Maybe not waste management, to James' point, or at least maybe they might be a laggard in the space. But everybody is trying to play it in some way, shape, or form. So there's lots of different ways to get exposure.
Thank you so much, everybody. This is Lily just chiming in again to close us out. I'm not seeing any other questions in the Q&A box, but I feel like we covered the full gambit today, everything from Magnificent Seven to Bitcoin to San Francisco real estate. So Sophia, Jim, and James, thank you so much for joining us. We hope to do this again soon. Maybe we can check in at the end of the year, see if some of our predictions today came true. And again, for everyone on the line, thank you so much for listening. We will have a recording to share if you're interested. And with that, enjoy your day, everyone.
Thank you.
Thanks,
Thank you.
everyone.
See you, Jim. See you, Sophia.